back and a happy Friday to you. This is Opening Bell, right live at the New York Stock Exchange. I'm Nicole Petal, ladies, and I'm so glad you're with us, getting you ready for the trading day. Joining me right now on set, Russell Hackman, president of Hackman Wealth and author of Wall Street is Not Your Friend. Good to see you.
Nice to see you, Nicole.
I know you're always focusing on volatility, for example.
Right.
Yesterday, the VIX was up 12%. Oil was higher. We didn't know what happens in the Middle East. You're getting, Google and Tesla pressure. I mean, what do you make of a day like that? When you have dips, are you seeing buying opportunities? What do you make of the big picture of the market this week?
I personally see some cracks kind of forming in the positive equity story. You really have, what by many measures is significant overvaluation. You have the Mag 7, which is 32% of the S&P 500, really losing their head of steam. They're actually on average down for the year, where the other 497 stocks, 93 stocks are up like 10% on the year. So, and now you have pressure for the market in the sense of one way or another, they're going to announce next week that liquidity is coming out of the system. Some people think they could even raise rates next week. It's unlikely.
What do you think? Do you think they'll raise rates next week?
That would really be the new, that would be, I think, pretty politically difficult for the Fed. On the other hand, it has happened before. I think it happened this way in 1994, where the Fed chairman kind of wanted to come out and basically slap the market across the face and say, I'm going to tighten. And if you listen to some of Walsh's most recent statements, he's saying, we will not tolerate inflation getting out of way. He said inflation is a choice, right?
But there are a couple of things when it comes to inflation. If oil comes down, I know oil was elevated recently. I mean, for example, American Airlines and said, listen, if we'd given our guidance 4 weeks ago, it would have been much better. But because of the recent surge in oil, now we've had to be more cautious. Oil is that sort of volatile inflation. It's not, real inflation until it's real inflation. The other thing is the jobs picture seems to be okay. We got in a light number when it came to jobless claims yesterday. Right. So it'd be a big surprise if they raise next week. But we might hear more from the committee when we get the minutes. Maybe there'll be more, because the committee didn't want the language of easing, right? Maybe more committee members will be leaning towards hikes. What do you think about that?
I definitely think that you're going to get a message out of the Fed one way or another next week that, hey, we're watching inflation diligently, that they may start shrinking the balance sheet. That's one of the things that was sort of on their list. All of those things are liquidity drainers.
Right.
You have, if you look at the bond market, the tenure now back up to 465, the 30-year at 5%. That's telling you that the market thinks inflation is a little bit out of the bag again.
And even up to 4.7 on the 10-year.
Yeah.
So what's your advice to investors here now?
Look, if you look at the S&P over the last 3 to 5 years, whatever period you want to look over, the S&P's up 90%, right? So when we're dealing with our clients and people that we meet, especially if you're close to retirement or you're in retirement, the way the markets have moved, some people have 60, 70, 80% of their money in stocks at these all-time highs when these cracks are forming. And so our advice is generally, hey, there's great opportunities to lock in gains, still get market upside. There's ways to convert gains that you have over the last few years into future income. That's a smart thing to do, right?
How do you do it? Because you said that there is significant overvaluation, I guess presumably in the Mag 7 you were referring to, right?
Well, even if you look at...
How do you do it? How do you convert into some gains? How do you stay invested for gains?
Well, there are innovative products out there, like ETF products, for example. Some are offered by a company called Innovator. That's in some of our portfolios. And they have, basically, it's like buying the S&P 500, but they've got a put option in there to protect you. So you're sort of hedging your bets a little bit. If the market takes off further, you're going to get your upside. If the market really weakens, you're protected. That kind of thing is pretty smart in today's environment.
In the asset allocation, as you're talking about these ETFs, I don't know if there's certain trends that you're looking for when it comes to these ETFs, because there's thematic ETFs, for example. You did mention the S&P 500. On the equity side, and then I want to talk about the allocation. Are you having, fixed income? Are you having international? Are you having alt investments? But on the equity story, what kind of investments there? I mean, S&P 500 and what else?
Right. Well, I mean, if you're looking at sort of since the S&P 500 is now like 32% Mag 7, 45% tech overall, if you're looking for alternatives to that, but still be in the equity market, you can look at dividend portfolios, which contain almost no technology stocks, right? You can look at diversifying in that way. You can look at, as we were talking about, some of these products with different, what I call attractive asymmetry, meaning you make money when the market goes up, you don't lose as much when the market goes down.
Yeah, understood. What about metals? I mean, what about gold?
I recently saw a chart for gold, and I do, even as a kid, remember the early 1980s. My dad was in the commodities business, and that was this Hunt silver scandal. That's when gold was $800 an ounce. If you actually look at gold through today, since the 1980s, its inflation-adjusted return is 0, right? So actually, going literally, you would have been better off just having your money in a savings account than buying gold the last 40 years.
You did say cracks are forming in the market. And so how do you navigate what we may be seeing ahead? What do you foresee in the next few weeks between now and year end?
Look, I think it's so much of the market is held up by tech, by AI spending. I'm sure you've been reporting on some of these new models that are coming out of China where they're saying, hey, maybe you can get the same kind of computing result at greatly lower cost, right? At the same time, all of these hyperscalers like Amazon, like Microsoft, like Meta, Oracle, et cetera, are supposed to spend $1 trillion this year. The crack in the market is, hey, what if we're spending $1 trillion, but the payoff is going to be a lot lower than we thought?
Not enough return investment, right?
Because the price of compute crashes, right? There's no one can say that can't happen.
Right. So, I mean, yesterday people felt that the big spend that was put out there by Google really sort of solidified that there is demand to merit the spending that's going on. You mentioned some of the other names like Amazon and Apple and or a few others, Meta, Microsoft, for example. We're hearing from some of those names next week. Are you looking to those names? Are you going to be? Is that very important to you to hear from those companies, or you sort of are more on this stay the course?
Well, yeah, we want to see what they're doing, but I think the bottom line is, if you look at those hyperscalers, the ones that we've all been talking about, they went from tremendously cash flow positive companies to now they're cash flow negative because they're spending all their earnings on AI, and they're even borrowing in order to finance these data centers. And so kind of fundamentally, as you sort of value a company, big positive cash flow is a good thing. All of a sudden you take the same company and swing into negative cash flow. That's not great.
Okay, sounds like you're less interested in that group, and there's cash flow worries and cyclical spending and investments. How about some of the old school? You mentioned old school. You said dividend payers. You went back in time a little bit. What are some of your favorite sectors? Is it your dad's favorite? Your dad was in commodities, so that's not it. But what are some of your favorite sectors right now?
You look at some of the, and this isn't for all of your money, I don't think. But if you look at some of the the dividend paying sectors like utilities, right? Like consumer brands. Like the big oil companies, right? Getting money into some nice dividend-paying stocks, most of which have massively underperformed these Mag 7 and the big tech.
Right.
That's a smart move.
So you think higher by the end of the year, or not necessarily?
In terms of the market overall?
Just overall, yeah.
It's very dependent on what happens with the AI story and what happens with the Fed. But I think, you can at one point be sort of wind at your back. I feel like the wind's in our face right now.
Russell Hackman, thank you, president of Hackman Wealth. Nice to see you.
Nice to see you.
Thanks, Russell.
Thank you.